Fed will have to move, not just on tapering, but on rate increases. That's not a crisis and not unexpected.
Right now, that inflation is clearly not temporary.
I would put 50% probability on the dissipation story and 50% probability on the persistent story.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Goldman Sachs rounds up the week for big U.S. bank earnings after the surge in pandemic deal-making and trading continued for rival lenders. A watershed moment for the crypto industry. Well, Bloomberg learns that the SEC is poised to allow the first U.S. Bitcoin futures ETF to begin trading. And European car sales are the weakest since 1995 in September as the chip crunch takes its toll. Later on in the program, we also speak to car company turnaround expert Stefano Aversa. Now, first of all, though, let's check in on the markets, and we're having a couple of encouraging news, actually giving a lift to some of these markets. Now, we look at Brent. It's always a good idea when talking about the energy crisis, and after the week that we have had, to look at Brent. It did hit briefly $85 for the first time since 2008, currently at 84.87. Now, we are expecting some measures coming from the European Union to try and help companies and give them a little bit of relief. Some of these measures have been laid out. We'll see what happens with it. Bitcoin, it was one of our top headlines with the SEC possible doing some Bitcoin ETFs. 59,278 is where we're at. And overall, there does seem to be a boost in the markets because of bank earnings in the U.S. that were pretty solid, and also a little bit of a boost because we're seeing China relax some of their rules as regards to mortgages. So actually loosening some of the restriction on home loans. Again, one of the other big stories, of course, Brexit between, the whole of the EU and the UK. I don't know whether they're talking tough at the moment or actually whether something could seriously happen. There are a number of scenarios where there's been tough talk, certainly from the Commission out of Brussels, saying if the EU messes up or if the UK messes up with Northern Ireland, there will be retaliation. So this, for the moment, is not really being played on the markets, but at some point it could, so keep a very close eye on it. So it's been another bumper quarter for U.S. banks. Morgan Stanley's investment team is, of course, scored their best 3 months ever, boosted by a pretty torrid pace of M&A. Citigroup equity traders also surpassed analyst estimates for a fifth straight quarter, and Bank of America beat as fees climbed at the company's deal-making unit. Now today, it's the turn of Goldman Sachs. Executive at all of those lenders seem to agree on one thing for the month ahead. Inflation is here to stay.
I'm not a buyer of this story that it's all transitory, the inflation story. The supply chain interruptions, natural gas and other things have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now.
Right now, that inflation is clearly not temporary, and as people worry about, it's more permanent, and a way to conflate that is start to get to work on it.
Inflation in general, obviously, is running at a much higher pace than I think we thought it would be, just a few months ago, and certainly going to be there for a little bit longer. We are seeing a little bit of pressure in wages, but not across the board. Really only in certain pockets of the company.
Well, joining us now for more on all of this is Michael Moore, our managing editor for finance in EMEA. And then I'm looking forward to having a conversation with Steen Jakobsen on some of the financials as well. But Mike, first of all, what are the overarching themes for U.S. bank earnings so far?
I mean, really, it's been a continuation of the trading and investment banking gains that we saw throughout the pandemic have continued. The four banks that we've seen so far have put up $33 billion in trading and investment banking revenue. If you look at a couple of years ago at this quarter, that was more like $25 billion. So that's a couple billion each of additional fees and trading gains. And it's really been across the board. For a couple quarters there, it was all about fixed income. Now it seems like the deal environment is lifting things. So that the investment banks are the kind of engines here. But I think there has been some disappointment on the other side of the house in terms of loan demand, both in consumer and commercial loans, and whether that will pick up, despite the gains we've seen in the economy.
So, Mike, very, very quickly, I mean, investors seem to, I guess, make a big difference between some of the banks. So what are we expecting for the next quarter? Is it going to be, I mean, financial is where investors want to be as a protection for inflation, because, of course, it changes the yield curve. Does that bode well for banks?
Yeah, I think if you start to see the Fed move and raise interest rates, that could be a boon to some of those lending businesses we were talking about. They've been at near zero rates for so long that, margins have been compressed. There's only so low you can take deposit prices. So I think that will be a lift to some of these lending businesses. And the banks have seen a big rally over the last year and a half. So I think investors are, setting a higher bar for some of these firms in terms of what they can do going forward.
Mike, thanks so much. Michael Moore, there, our managing editor for finance in the EMEA. Now we're joined by Steen Jakobsen, Chief Investment Officer at Saxo Bank. And Steen, I'm delighted also to have you in the studio. I love your notes. I always get feedback, actually, that you look at the markets in a slightly different way and often are right about them. So first of all, how should we look at some of the earnings seasons that we've had so far as it pertains to inflation? So it's all about inflation. What happens to inflation now?
I think the important part is all the CEO is now saying it's not transitory, which is the narrative that the Federal Reserve has been feeding us forever. And I think Federal Reserve is really way behind the curve. So I think the banks are preparing themselves for an increase in the yield curve, as you talked about, which will improve earning down the line. And down the line, of course, I think they know that the market will correct itself.
Yeah. But Steen, how can policymakers get it so wrong? So I don't know whether, I actually don't know who to believe, because it's two cases. You either look at, markets and chief executives, or you look at central banks. And there's a feeling in central banks that actually we're having all these shortages because people are overbuying as they prepare for shortages. So it's like a feedback loop, like the waterfall effect. And that in 6-7 months, we're going to have suppressed prices because everything comes roaring back.
I think that's an interesting conversation, but that is the political narrative created either by politicians or financial markets. So how I see the world is that we've had a financial world that's been totally separated from the real economy. So our number thing, which I told you 50 times, is that the physical world has now become too small for the political aspirations and policy that we enact, which is fiscal transfers and liquidity provision. Interesting. So if it was supposed to be that it's just you and me buying too much toilet paper, then of course it will be sort of mitigating itself over time. But there's nothing that liquidity or fiscal boost can do to increase the base load in the UK in terms of energy. And every single energy and inflation spike that's been in history has always been driven by energy crisis. We have an energy crisis in October, not in January, not in February, not in March. So God forbid that we actually get a very cold winter this year, then we'll have a real issue at hand, because we cannot increase the base load. We have underinvested into it. And you see now that mining companies like Fortescue makes more money than a payment company like Visa. Yeah. And still people are not buying. Do you know what the PE is of Fortescue is? 5. So unless you are, if you don't have to play by the narrative, which is ESG, a very loosely defined ESG, there is massive opportunity in the real economy, logistics, mining, and everything else. And I think the example of Fortescue, of course, is probably the most evident and clear one.
So, Steen, what does it mean for a policy mistake by central banks would be what? Not hiking rates? I mean, at the moment, they're talking about tapering. Should we now price in like proper rate hikes? And what does that do to companies and the economy and markets?
So we need to price in catch-up effect. So I think you and I have grown up in a market that works what we call in continuous price action. So 2022, 2023, prices. Now we see price jumps. You see silicon jumping by 300% in the space of a month. And I think interest rate would do the same ultimately, because instead of having this slow grinding move up and down, it's 153, next day you come, it's 156. One day we're going to come in and it's 175. Why? Because of the policy mistake. And what happened with Powell and Fed in September was no mentioning of the word transitory in the statement, and ever since the market's been repriced. In the UK, we have priced 60 basis points over the last 2 weeks. So the policymakers are behind, and when they are behind, they need to get ahead. For why do they need to get ahead? Because in their mind, they need to have interest rate high enough to be able to cut them again. So they will drive interest rates simply from the policy reaction for them, which is we need to get rates back to a level where we can actually cut them again.
The UK, how much separate do you keep the UK because of some of the driving forces that are very unique to the UK because of Brexit and also lack of drivers?
I think it's a great laboratory for what goes on in the rest of the world. It's a small open economy. You have sort of embedded very, very big lorry drivers and the structure and everything else. But think about like the best performing windmills in the UK right now is the windmill offshore in Scotland. Why are they the best performing? Because they're not working. Actually, the government pays them not to do electricity provision at a time where you're short baseload. We have a baseload effect. Electricity, getting these turbines to run on a constant basis cannot be ruled what we do. But the policy response will be more green, more fiscal, and then we're just going to make the world even smaller than it is physically relatively to financial markets.
Have you started buying Christmas presents because of the supply chain issues?
You know I'm cheap, so I don't
so
really spend a lot of money on Christmas.
We'll give a call to Father Christmas. Steen Jakobsen, Chief Investment Officer at Saxo Bank, stays with us. We'll talk a lot more about China and cryptocurrency next. Coming up, Bitcoin futures will be allowed to trade from as soon as next week. We'll speak to Eddie van der Walt and Steen Jakobsen of Saxo Bank on this next. If you have any questions, you can send them through on IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's turn to a Bloomberg scoop, and we've learned that the SEC is poised to allow the first U.S. Bitcoin future ETF to begin trading. Now, it would be a watershed moment for the cryptocurrency industry. Now, let's bring in Bloomberg MLive's Eddie van der Walt, our great crypto watcher, and we'll be back with Eddie, and we'll be back with Steen Jakobsen in just a second as well. Eddie, look, first of all, this is a big scoop because actually it just means that it could go much more mainstream than it already is.
Oh, absolutely. And we have seen a price reaction to it, right? I think this is a really big story. Bitcoin has been waiting for this. Of course, US investors could get access to ETFs via other venues, like in Canada or in Europe. But this is a really important development because for a lot of people, they want to trade on their home exchanges, and now they can do so if it's traded in the US. Now, there's one thing that I will keep in mind, though. This is backed by a futures contract, not by actual Bitcoin. And that actually, in the long term, is not extremely bullish for Bitcoin demand, I don't think.
Eddie, we also had a survey saying that there was a large chunk, actually, out of 7.1 trillion, I think it was an MSCI survey, saying that there was like a lot of exposure to cryptocurrencies. I mean, does that make it much more present, the regulation, if it's going more mainstream, without actually the, I guess, old street finance realizing?
Yeah, I love that story because it just told the mainstream investor that whether or not you're a crypto bull, crypto is creeping into your portfolio, right? Via diversified funds, just because these companies are becoming so big. And listen, there is a lot of excitement about cryptocurrencies, and because they are so bullish, we will see the exchanges and all of the infrastructure companies that deal with cryptocurrencies. They will continue to do, to grow, and therefore, all of us will get greater exposure to it.
Thank you so much, our Bloomberg MLive's Eddie van der Walt. Now we're back with Steen Jakobsen. Steen, are you like fully invested in crypto?
Fully invested. I have 7% fixed in cryptocurrency in my 100-year portfolio, which is Saxo Bank sort of educational / recommendation. So yes, we are fully. And I think what happened over the course of the last 24 hours is just vindicating what some people in the industry, among them Kailey Leinz, has been saying for a while. You have to remember that the evolution of asset classes as a portfolio manager. In the 1960s and 70s, portfolio managers in the UK and the US didn't have real estate. No. So they went to real estate to get diversification and access to a different attribution in terms of return. In the 80s, it was hedge fund. In the 90s, it was private equity and venture capital. So it's not unnatural that we have this evolution. I think what we're happening right now with this, that happened overnight, but also generally with the acceptance of we're moving towards more KYC compliance, and the way I trade the ETF, of course, is through exchange based because then I have full disclosure relative to both my employer but also to the tax authorities. So we are moving into the fact that it's becoming a real asset class, basically.
But is it Bitcoin, or actually is it something? So I keep on hearing that Bitcoin is the thing right now, but in 1 or 2 years, because of regulation, there could be another greener product out there. So maybe we don't even need to look at Tether and things like that.
So there are 3 iterations. Blockchain, which was the first one, has scalability, so environmental issue, and basically it's, but it works on the fact that it has a limited supply. You have standardized contracting, Ethereum and the likes, and then 3rd generation, Polkadot, Cardano, and another thing. I think the ultimate winner, you have to remember the construction of crypto is really that it's the payment for doing transaction on a blockchain. So ultimately the winner, which is indirectly your question, will be the technology that is compliant to environment, which is compliant to scale, and which is probably also KYC in order to be accepted by the payment system.
But we don't know which one it is yet.
We don't know which one it is, and you need all these things to fulfill. And right now people are saying, Bitcoin can do whatever it needs because it's just a store of value. Standardized contract, okay, but as a commercial venture, I always make the analogy. It's like Bitcoin and cryptocurrency right now is like Nokia phone when we got the flip phone and we had text messaging. You and I was massively excited, right? But it really only took off when Apple introduced the powerful iPad, the iPhone, right? Where you have multiple apps, we have multiple amount of people working on the apps, which is called nodes in the crypto world. But like a network like Ethereum has, I think, 25,000 people working on it right now in nodes. It needs bigger scale, it needs to be bigger, but it's definitely being adopted institutionally, now also in a legal framework, and it's becoming a real asset class, in my opinion.
Steve, we're out of time. I need to talk about China and Brexit. So what do you want to do first? China, how do you play it?
China has changed the business model. They're just going from being, trying to be emulating what happens in Hong Kong and the US, then moving to a Scandinavian model. The amount of economists in China now ask me for papers on welfare and the way we do things in Scandinavia. So Xi Jinping wants to take himself away from Deng Xiaoping, and he sort of opened up with China. Now they're the dual economy, harmony, and everything else. But right now it looks like there's a fundamental value in China.
Right, but what does that mean actually for their relationship with the US investors or Western investors in general?
I think the pivoting out of Afghanistan was a move to actually afford themselves to be competing with China. So I think that meeting is still supposed to happen and going on. But I think a lot of investors asking the question. I heard earlier on the show this morning also had someone in talking about it. But bottom up, all these companies is what the investors in Asia need. Don't forget, MSCI Asia is 40% China. So where you want or not, if you're an Asian investor, you need to be invested in these companies. So I think people are picking up on the side. But I think overall, back to the whole thing, they also have an energy crisis, right? And they are slow in terms of adoption of vaccination. So I'm a little bit concerned for all of the markets in the sense that we have this rate sensitivity that comes out of the energy crisis. And don't forget, we are not even into the winter yet in terms of the impact on energy prices. So
could you actually see a big market correction in the next 2 to 3 months, coupled with, that could come from COVID, lockdown, monetary policy mistakes?
The next move comes from what I call the step ladder increase in inflation and rates. Okay. And every recession we ever seen has come from energy crisis. So you have the setting of energy crisis. Put very, very quickly, what we need in the world is the marginal cost of energy go to zero. Right now it's going to infinity. So that is going to hurt both the market, the interest rate, and inflation.
All right, Steen, thank you so much. We'll have to get you back because we didn't even talk about Brexit. We talked about the Bank of England and inflation, but not about Brexit.
No one wants to talk about
we
Brexit
will.
anyway.
No one wants. But are you playing it? Are you buying stuff in the UK? If it turns ugly?
Yeah, but I'm actually very negative on growth in the UK because of what Johnson did. So I'm very negative on sterling.
All right, Steen, thank you so much. Steen Jakobsen, their Chief Investment Officer at Saxo Bank, joining us this morning. Now, coming up later in the program, Belgium's central bank governor tells us policy will remain supportive for the near future, even as supply constraints add to uncertainty. We'll hear from our exclusive interview from Pierre Wunsch. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned China is loosening restrictions on mortgages at some of its biggest banks, adding to signs of growing concern by authorities about contagion from the Evergrande debt crisis. Financial regulators told some banks late last month to accelerate approval of mortgages. Lenders were also permitted to apply to sell securities backed by residential mortgages. Now, a partially destroyed historic Banksy painting has sold in London for a record £16 million. Previously known as Girl with the Balloon, the piece was partially shredded as an artist's prank after it came to auction in 2018. Renamed Love is in the Bin, it's become a cultural phenomenon. After closing the bidding, the auctioneer joked he was relieved the artwork was still there. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, I'm disappointed you weren't the buyer of the Banksy. I have to say, it was pretty punchy. Even I had a double take in saying, wait, is it 2 million or 24 million? We'll talk a lot more about art shortly. Coming up, the EU sees its worst September for car sales since 1995. With me to discuss is company restructuring expert and Alixpartners London managing director Stefano Aversa. That's coming up shortly, and this is Bloomberg. Goldman Sachs rounds out the week for big U.S. bank earnings after the surge in pandemic deal-making and trading continued for rival lenders. A watershed moment for the crypto industry while Bloomberg learns the SEC is poised to allow the first U.S. Bitcoin futures ETF to begin trading. And European car sales are the weakest since 1995 in September as the chip crunch takes its toll. Up next, we speak to the car company turnaround expert Stefano Aversa. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I keep on getting messages from traders saying we have made it to Friday. Indeed, we have made it to Friday, so happy Friday, everyone. I'm Francine Lacqua here in London. The market's definitely on the move for a number of reasons. First of all, they look in China and actually think what we've heard from China in terms of some of the loosening tactics, certainly for mortgages or home buying, is seen as a positive. The other thing we need to watch out for is Brent crude. It was at $85 a barrel very briefly, but we hadn't seen that since 2018, now at 84.84. Again, this just goes back to some of the concern surrounding the energy crisis. We're also hearing from the Commission and European leaders trying to say, well, we need to fix the companies somehow or give them a little bit of relief. So we could see a bit more on energy price relief over the next couple of days, and then Bitcoin 59,068. Again, markets supported by some encouraging U.S. bank news. Now, car sales in Europe have just seen their worst September since 1995, with new car registrations diving by 25%. Now, the ongoing semiconductor shortage is causing production losses. The news isn't all bad for automobiles, with electric vehicle sales continuing to accelerate after a good 2020, fueled by government incentives and a change in attitudes. Well, we're joined by Stefano Aversa. He's Global Vice Chair and EMEA Chair at Alixpartners. Stefano, right here, has more than 30 years experience driving turnarounds for industrial companies, including car makers. So, Stefano, thank you so much for coming back to the studio here at Bloomberg. Look, Stefano, there's some, we talk about the chip crunch, and we talk about it almost on a daily basis, affecting the supply chain. I have to say, for me, when I read the headline that even Apple, deep pockets, wonderful supply chain, is being hit, I thought, well, what hope is there for everyone else?
Yeah, it's actually a bigger problem that look at the beginning. There are a number of reasons why we are where we are. The main reason is that supply chain, particularly long supply chain like chips, let's take into account that it takes about 9 months from a chip to go from the start into a vehicle. Do not like shocks, they like stability. And in the case of pandemic, there was a shutdown of plants, both automotive plants and chip plants, and it takes 9 months to restart. Plus you had to refill the supply chain, and automotive represent only 8% of the total chip market, so they are not particularly important. And also there are chips that are a bit special because they are subject to thermal shocks, to vibration, so they tend to be on traditional and smaller wafer, not to be too technical, but it's a 200 millimeters, while the mass efficient wafers now are 450 millimeters. So the capacity in the last several years have been on the large wafer.
Right.
So the combination of smaller capacity, shock in supply chain, and the fact that there have been a significant ups and downs created the problem we are in.
But Stefano, so how do you see the energy transition as well? So one of the other things that we try and figure out is that if you're a car company or if you're a consumer and you say, oh, I want to buy a car, but I don't exactly know how much I need to pay if it's not a completely electric one, do you just use your old car until it dies before you understand rules and regulation going forward? Are you expecting better technology? Like, it seems that there are a number of unknowns for car makers that it's almost difficult to pick out what the main reason for some of this, pressure is.
There is a lot of uncertainty at all levels, including at producers' level. So I think it's a personal choice. It depends really on emission. I think if you are living in metropolitan areas, electric can be a solution, particularly if you have the possibility to charge it at home. If you need to travel several hundred miles per week, probably it's not the best solution today yet, for all the reasons that are well known, the infrastructure, the charging infrastructure, the range, but also, frankly, an electric car cost about between $8,000 and $12,000 more. So also there is, from a consumer standpoint, this is a pretty heavy hurdle.
Yeah.
So if you look at the future, I think I suggest that people really evaluate their mission, how they're going to use them. I suggest that they actually wait for next year. There will be a lot of new cars coming. There will be much more choice. There will be about 100 new electric vehicles coming in the market. And with more choices also will come probably some also reduced prices.
But so, Stefano, is this what's happening now? So if a year ago we had spoken and I said, well, 2021 is going to be worse than 2020, I mean, probably no one would have believed us, right? So how do you look at today's numbers? And what does it mean for the kind of pressure? Could we see car companies, downsizing quite significantly?
Okay, there are two different phases. The phases of the pandemic brought down by about 20 to 25% the volumes. That was 2020, particularly the second through the fourth quarter of 2020. Then there was a restart, and it was actually a pretty quick restart. China basically had a 2020 which was about the same level of the year before. US restarted relatively quickly. Europe was slower. And then in the middle of the restart, the chip crisis started to hit. At the beginning, we forecasted between 4 and 5 million. Now we just, as Alixpartners came out with a new forecast of 7.7 to 8 million cars, which means 210 billion of losses for the manufacturer. And it could be even more because you have a compounded effect of the shipping constraints.
Energy, I imagine?
Energy itself, yes, of course. You drive a bit less. But more than half of the problem we have today are not generated by the pandemic, but the really lack of components.
Yeah. Stefano, thank you so much. Hold that thought because we'll talk a lot more about some of the anxiousness maybe that we can see in other sectors as well. Stefano Aversa, Global Vice Chair and EMEA Chair at Alixpartners, stays with us. Coming up, patience required. Well, Belgium's central bank governor tells us that a bit of inflation could be a good thing for Europe, but we'll have to wait to see how the ECB will react. Well, our interview is next. This is Bloomberg.
The United States wants to oppose China. Europe wants to engage China. So there is a difference of view. We need to discuss about that because this is clearly a strategic question.
The French Finance Minister Bruno Le Maire speaking to Bloomberg about Europe and its allies' approach to China. He's also calling on the U.S. to drop trade tariffs against European countries after the global deal on corporate taxes. Now, America is unhappy at French levies, of course, on tech firms, which Le Maire says will be abolished when the new global agreement comes in. Well, turning to from taxation to inflation, CPI in the euro area is also 3.4% year-on-year, far beyond the ECB's goal of 2%. Some policymakers have recently started to warn that price pressures could become more persistent. Well, the Belgian central bank governor Pierre Wunsch told Bloomberg earlier this morning that patience will be necessary before the ECB knows how to act.
So the debate today is a bit more about whether inflation is going to be temporarily higher or whether it's going to turn into something which has a dynamics of its own. I think there are very good arguments to say that a lot of what we see today is temporary in nature. We have base effects and of course we have supply constraints, but also because it's lasting a bit more and we know that some of the supply constraint will take some time to abate, maybe a year or so, that it could turn into something that is a bit stronger in terms of second round effects, and there is uncertainty there. And actually, we could afford some second round effects because we want to go back to our target. We are not at our target in Europe, which means that our policy will have to remain supportive. And I think it's important to make the distinction between, exiting the PEP, which was an emergency program that was really related to this COVID crisis, and the fact that if we decide to exit the PEP, and I think, the economy is moving in the right direction, so we could at some point decide that we still have to, fall back on our not traditional tools, but the tools that were there before, the APP, TLTROs and others, because we are not at our objectives. So we need, in any case, to remain patient.
Well, that was our interview with the Belgian central bank governor, Pierre Wunsch, from this morning. Now, as the ECB keeps the taps open, what effect is that having on companies? Well, still with us is Stefano Aversa, a global vice chair and the EMEA chair at Alixpartners. And Stefano, we talked, first of all, thank you so much for staying on, but we were talking a little bit about this inflation dynamics and what this means for monetary policy. Is there a worry? And we've heard from Mario Draghi before he became prime minister. We heard from, the G20, the G30 group, actually, the worry about zombie companies, that once you get rid of, this monetary policy, we're going to be left with a ton of companies that just can't survive. Is that true?
It's still true, even if for the moment there is this blanket that has been put on the economy. Most companies received guaranteed loans from the state or agencies, and I think that would be still okay for several months to go.
Yeah.
Having said that, during 2022 and certainly in 2023, some of these loans need to be repaid. And I think we'll see some of these so-called zombie companies to be taken care of. So there will be a significant wave of restructuring consolidation.
Stefano, I just need to bring everyone aware of some news on Alitalia, which is just breaking as we speak. So the new state-owned airline, of course, ITA, we know a couple of days ago bought 28 Airbus jets, and we thought this was on a path to success. Now we understand that this Alitalia successor called ITA does not see a standalone future, and they have been approached by top competitors. I don't know whether we are going to see, I don't know how that translates into your world. Are we going to see more M&A for some of these companies that maybe don't need or should not be surviving unless they're like crown jewels of a country?
Yes, I mean, I think ITA or Alitalia is a case in point. There are no chances that a company of the size of Alitalia, without a very strong partner, or even better, being part of a larger group, can survive. The competition in Europe is fierce, and nobody can work only with regional planes with the size of Alitalia. So I think that was declared also by the new management. They are looking for an alliance, and the sooner the better.
Yeah, which is exactly what's going on right now. I think we have an interview with the chairman saying that, look, they've been approached and actually they don't see it as a standalone future. Is this symptomatic of other industries? Is this just for the airline industry also because of the pandemic? Or do you think we'll in general see more M&A and more consolidation amongst other sectors?
There would be consolidation, but probably done in a slightly different way. The world moved away from the globalization, the way we knew it in the year 2000. It would be much more regionalization. But in industries that have very high investments like pharma, automotive, aerospace, you need to have a global size to compete. Other industries like consumer goods or telecom, etc., can actually survive and thrive at regional level. But we will see a lot of consolidation at the regional level.
We were talking a little bit before about zombie companies. I mean, could we actually see a bloodbath in certain parts in Europe, but also the UK, when things are starting picking up? I don't know whether you see like this blanket of safety because of the pandemic that being taken out, and how many companies you're actually expecting to be in real trouble afterwards.
I think the solution is going to be mainly political, and I don't think that the blanket will be or could be taken out abruptly. So I expect that to be done, also because of the political pressure. There will be always a next election next month, next quarter. So I think they will find solution to mitigate the impact. But we are working on a number of situations of reconversion of entire plants or entire, in some cases, industries that through, for example, the energy transition, entire industries sectors are disappearing and need to be reconverted. And you have to think ahead, 3, 4, 10 years even. And the governments are starting to become smart in attracting and putting pressure on companies to help retrain the workforce, to bring new innovation, new products, but also, frankly, to attract new investment from all over the world. The reality is that that process will take some time. Not everybody will be easy to reconvert, and it's going to be a transition which will take the next 10 years. So fascinating times, but also for
busy
some
times.
difficult times.
Yeah, difficult times and busy times for you. What does it mean for the UK? So again, it's very difficult actually to read the situation, given also the acrimony that we've seen over the last couple of days between the UK and the EU. What does it mean for UK companies here?
UK has a bit of a double whammy because of the Brexit in addition. For the services, we learn how to do it virtual. I think UK will continue to thrive. I think London is not UK, will continue to thrive. But the industrial footprint of UK has started to suffer already for some years and is going to be suffering going forward. Again, except for some industry like food, retail, when we talk about more technology or we talk about automotive, we talk about aerospace, there will be certainly a negative impact. For very practical reason, the UK logistically is not the best place to supply Europe, but also the cost. We also have to see how the currency will deal. It has some recovery, but UK has the possibility to use the currency as a competitive weapon.
Stefano, thank you so much for coming on today. Stefano Aversa there, Global Vice Chair and EMEA Chair at Alixpartners. Now coming up, with just 2 weeks to go until COP26, are countries sticking to their pledges on climate aid from Paris 6 years ago. We tally up the numbers next. This is Bloomberg.
Whether it's heat waves in Canada, storms in Texas, or flash floods in Indonesia, no country is immune from extreme weather events fueled by climate change. But not everyone is equally to blame, and not everyone can afford the massive costs of cleaning up disasters like this, or just as importantly, shifting their economies away from these sorts of things and embracing more of these. Take Africa, for instance. As a whole, the continent is only responsible for around 3% of global greenhouse gases, yet it's among the most vulnerable to the knock-on effects of climate change. Take the cyclones in Mozambique or droughts in Ethiopia. Those types of extreme incidents can impact food production and increase the risk of malaria. Some argue that wealthy nations industrialized over the last 2 centuries precisely because they were able to burn fossil fuels like coal. Now the goal is to keep these fuel sources in the ground in an effort to stop temperatures from rising even more. But what if you need to tap those fossil fuels to cheaply industrialize your developing country? While Joe Biden's doubling of the US climate pledge to $11.4 billion is a step in the right direction, a global problem needs a global response. And that's what the United Nations Framework Convention on Climate Change wants to solve. How to get rich countries to agree to a plan to help poor countries pay for solutions. Over a decade ago, wealthy countries promised that by 2020, they would help to raise $100 billion a year for projects to combat climate change in poor countries. But support was lackluster even before the pandemic hit. And once that took hold, governments worldwide shifted their focus to emergency response packages to cope with the shock of the outbreak. Another challenging element is that most of the money raised so far has gone to green technologies like wind turbines and solar panels meant to mitigate climate change. But fewer funds have gone to resilience measures like flood barriers needed to help countries adapt to extreme weather. UN Secretary-General Antonio Guterres has said adaptation and mitigation money should be split 50-50. Developing countries have noticed the failure of rich countries to deliver on their pledge, and the inequality of the coronavirus vaccine rollout has heightened tensions. Without the promised funding, they say they are unable to announce tougher carbon-cutting goals, which are desperately needed to keep global warming below 1.5 degrees Celsius. Even if the $100 billion goal is met, the reality is that trillions, not just billions, will be needed to pay for the green transition.
Bloomberg's Jess Schenkelman there with a look at the key issues going into COP26 summit in Glasgow in just a couple of weeks from now. Now, you can watch more from Bloomberg Green this weekend on TV and online. This week's episode focuses on the causes and solutions to the global energy crisis. We'll also speak exclusively to the chief executive of Ecotricity about the UK utility landscape after 14 suppliers have already gone bust. So let's now take a look at some of the other key events to watch out for today. At 1:30 p.m. London time, Goldman Sachs reports earnings. We'll see if they've kept up with rivals that have seen a surge in deal-making and trading revenue. Later this afternoon, Angela Merkel will meet with the Belgian Prime Minister in Brussels as coalition talks rumble on in Berlin. And throughout the day, Brexit talks continue between the UK and the EU over the Northern Ireland Protocol. Well, the EU's chief Brexit negotiator has voiced optimism that the two sides will arrive at a solution in the next 2 weeks. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz will be in New York. We'll have a full roundup of the market stories. We'll also talk about energy and, of course, Bitcoin. A big Bloomberg scoop on what the SEC will do in terms of Bitcoin ETF. This is Bloomberg.
Inflation round is not transitory. We should take it seriously, and central banks should move quickly.
I think the market has digested that the Fed will have to move, not just on tapering, but on rate increases.
We don't think that the Fed will move to preemptively. We think that the Fed will be more cautious.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, October 15th. Our top stories today. Equities on the march. Stocks and U.S. futures are higher today. Investors are encouraged by strong corporate profits and China's move to loosen restrictions on home loans. Goldman Sachs in the spotlight. While the firm's report will cap a busy 3 days for major bank earnings, investment banking fees are likely to soar. And breakthrough for Bitcoin. The SEC is set to allow the first Bitcoin futures ETF to begin trading. That's a very nice Bloomberg scoop. So, Kailey, if you look at the markets, they're actually pretty confident. I don't know whether they have a Friday feeling, but certainly they're looking at strong U.S. corporate earnings, especially the banks, and they're powering ahead.
I think we all have that Friday feeling today, Francine. It's been a really, really long week, and it is indeed almost over, including the last of the big banks reports coming from Goldman Sachs in just a few hours' time. Now, let's quickly recap what happened in the Asian session, because broadly it was a positive one. You had most stock benchmarks in the green, a lot of currencies and bonds getting a bid as well. Hong Kong and China were both up on the day, eased by the fact that China is going to be easing curbs on mortgages for the rest of the year, really trying to stem the Evergrande crisis. That actually helped out the Hang Seng Property Index, which was down as much as 1.3% at one point in the session, but actually managed to end the day in positive territory by about 0.5%. The big outperformance in Asian equities, though, came from Japan, with the Nikkei up 1.8%, and that basically is due to the weaker yen. The yen, once again, the biggest underperformer in both Asia and G10. It is weaker against the dollar by 0.5%, and at 114.25 on dollar yen, that is the weakest level of the yen against the dollar going all the way back to 2018. Finally, had to point out coal futures as well, higher for a fifth day in a row, a fifth day of record highs for thermal coal in China. Thank you very much to the power crunch, as well as mining, coal mines being flooded in China. Coal futures at another record high today, up about 5%. Now, here in the U.S., we are coming off the best day for the S&P 500 since all the way back in March, and it does look like the gains will be continuing today, with futures up about 0.3% ahead of those Goldman Sachs reports. By and large, the bank reports have been quite strong. In the bond market, you are seeing some selling. The 10-year yield is up around 3 basis points. We're sitting right around 154 on that rate. Crude oil is heading for its 8th consecutive weekly gain. WTI this morning up about 0.7%. It was trading above $82 a barrel earlier. We are just off of that level now. And then I have to point to Bitcoin, as Francine alluded to, a Bloomberg scoop overnight that the SEC is set to allow the first futures Bitcoin ETF to begin trading. As a result, Bitcoin up about 2.5%, trading right around $59,000, Matt.
Kailey, I also want to point out, MSCI came out with a report that Bitcoin is now tied to $7.1 trillion in stocks. You could see that as a positive story because more and more large corporations are embracing the technology, or you could see it as a concern because regulators, maybe even beyond Gary Gensler, will start to pay more attention to crypto. Take a look at markets, though. None of that's holding us back at all. In fact, obviously, Bitcoin is very positively correlated to equities, and we're rallying here in Europe pretty much across the board. You can see the biggest gains in Ireland and Italy, but we're up in the UK, we're up in Spain, France, and Germany as well. We also have yields rising here. As Kailey mentioned, in the U.S., you see treasuries selling off and yields rising. Here in Germany, it's the same right now, up to negative 17 basis points on the bunds. I thought really interesting to look at Brent crude. Now, this is the global benchmark. I know New Yorkers are going to look at WTI more instinctively, but everybody else in the world trades Brent. And for a while today, it was over $85 a barrel. It's come back down a little bit, 84.68, but still up there. And then the pound is moving higher than any of the other major currencies here against the dollar. It's outperforming the euro. It's outperforming the Swissy right now. 137.21, the level on the British pound, as we worry more and more about Brexit, Francine.
Yeah, we do.
Again.
I mean, the sound music from both the EU again and again and the UK has just gotten worse and worse. Acrimony is a pretty good word to describe that relationship right now. Now, a look at what else is ahead today. Big bank earnings continue, with Goldman Sachs reporting at 8:30 a.m. New York time. U.S. retail sales will also be closely watched at 8:30 a.m. New York time. Italy then putting in place some of the strictest anti-COVID measures in the world. All public and private sector workers will be required to show proof of vaccination from today, even if you go to work. Now, more on that Bloomberg scoop. We did learn that the SEC is set to allow the first U.S. Bitcoin futures exchange-traded fund to begin trading. Now, this would be a watershed moment for the crypto industry. So let's get more on this with our Danny Berger. Danny, this is such a big deal because it makes it more mainstream, I guess.
It does. And you and I both have talked to a lot of Bitcoin bulls who really use this fact that they think an ETF will be approved as a thesis, as one of the pillars behind why they like Bitcoin, why it will go higher from here. And as Kailey just pointed out, we are seeing it move higher, about 2.3%. Now, this isn't the first Bitcoin futures ETF, but it is the first in the U.S. should it go ahead and start trading next week. But really what is key, what the Bitcoin bulls really want to see is not an ETF that's based on futures. They want to see it backed by the actual physical Bitcoin itself, although I realize saying physical Bitcoin a bit of an oxymoron. But this would allow Bitcoin to be more liquid. More people would start trading it because it's just available to a wider audience of investors because ETFs are so easy to buy and sell. So barring a last-minute turnaround, it looks like we will get the futures one, which just pretends well for an SEC approval of an actual Bitcoin-backed ETF.
I have to mention persistently transitory, which is an oxymoron that Mohamed El-Arian pointed out to John Farrow yesterday. I'm really in the market for those right now.
Good day for
I talked about the
oxymorons.
MSCI story, Danny. $7.1 trillion where the public companies have exposure to crypto. What kind of risk does that pose to an everyday investor?
Well, it kind of touches on the lightning rod, which I think you framed really well, Matt, that this could bring in more regulation into the fore because, yes, for an everyday investor, this might mean that they do have exposure to Bitcoin and they don't even realize it. Of course, they're the companies you would think of at Tesla where they put a lot of their balance sheet in Bitcoin, but you also have to think of the JP Morgans of the world that have started to dip their toes in offering crypto services. So if you're an investor, you own a wide benchmark, all of a sudden you do have some exposure to cryptocurrencies, and perhaps you don't like crypto, or perhaps you're worried about the ESG implications of mining or transparency. So this is something this MSCI study shows that you now have to be aware of.
It's like Jamie Dimon says, he thinks it's worthless, but if clients want it, JP Morgan has to deliver. Thank you so much to Bloomberg's Danny Berger. And let's stick with Wall Street because 5 big banks have reported so far and shown that business is booming. Bank of America's CEO Brian Moynihan spoke exclusively with Bloomberg yesterday after his bank reported earnings that topped estimates.
We're back. In other words, the activity levels and what goes on day to day is bigger than it was before the pandemic.
And the busy week for U.S. bank earnings continues today with Goldman Sachs rounding us out this morning. Sonali Basak, Bloomberg Wall Street reporter, joins us now. Sonali, we are almost there. For Goldman today, is it once again going to be all about the deal makers and those advisory fees?
Yeah, I mean, we can easily expect Goldman to make almost as much or more than double than the amount it was making in merger advisory fees than it was in 2019. Wow. So we are back to more than normal in that respect. So for the traders as well, the expectations, remember, they were muted coming into earnings relative to what we saw at the other two banks. So if Goldman comes in at $2.2 billion worth of equity trading fees, they come in just below Morgan Stanley and JP Morgan. So the number to really beat is $2.6 billion at JP Morgan, and $2.8 billion is the big number at Morgan Stanley. So competitive market, but who's watching, right?
We are. Obviously, investors are paying very close attention, Sonali. And yesterday, I thought it was interesting. The biggest losers on the S&P 500 in terms of point deductions for a while were financials, and then they turned around right around noon. What are investors looking for? Where's the bar?
I mean, the bar was very high coming into earnings, but remember, it's been such an incredible deal-making quarter, and some of that is continuing, Matt. So if you look at IPOs, undercounted here, the equity underwriting fees for Goldman are expected to be under $1 billion. That was more than $1 billion each for JP Morgan and Morgan Stanley. I mean, just a stunning number. And Goldman right now has the most share, according to our league tables, in equity underwriting. That is both lead left deals, it is equity overall, as well as IPOs, and as well as overall book running. So there's been a tremendous amount of activity despite the volatility. Volatility has been in a sweet spot, so much that you had James Gorman yesterday tell us that the Fed should pop the bubble a little bit here and raise as early next year.
Sonali, thank you so much. Sonali Basak there on some of the U.S. Wall Street banks. Now over to Washington. President Biden has signed a bill that raised the U.S. debt limit until December 3rd, setting up another bitter bipartisan battle, actually, that will likely unfold in a matter of weeks. Let's get straight to Anne-Marie Hordern, a Bloomberg Washington correspondent who joins us from D.C. So when are we going to see this acrimonious partisan battle resurface, Anne-Marie?
I think it's going to start happening starting next week when the House and the Senate, Francine, are back in session. They're off this week for recess. But this is just a Band-Aid, as you mentioned. This really just brings the U.S. to be able to, the Treasury to be able to continue borrowing, pay off debt. by early December, potentially some leeway, but this is what that $480 billion is going to around December 3rd. That's also when the government, that stopgap funding measure to keep the government up and opening, federal employees paid, et cetera, that runs out as well. So it's going to be very busy weeks here in Washington, D.C., big partisan showdown. On top of that, the Democratic Party is still working out how are they going to move forward on their reconciliation, that big social spending package.
And this isn't the only headache for President Biden. We are still in the middle of a pandemic. And he said yesterday that U.S. health officials will decide soon on Pfizer and BioNTech's COVID-19 vaccine for kids aged 5 to 11. And of course, that was after the FDA approved the Moderna vaccine booster for older and high-risk individuals. Just take a listen to what Biden said at the White House yesterday.
We're going to continue protecting the vaccinated. This week, the Food and Drug Administration and the FDA is reviewing data on Moderna and Johnson & Johnson boosters. We expect a final decision from the FDA and the Centers for Disease Control and Prevention, the CDC, in the next couple of weeks.
So, Anne-Marie, how much more can the Biden administration do to push people to get their shots, the initial ones?
Yeah, the initial ones is a big deal, and this is just constant outreach, especially in rural communities and a lot of states that we are not seeing an uptick of those first initial shots. Yesterday was really about the boosters, though. The Moderna one, the FDA did not actually approve it yet, Kailey. It is the advisory board that is recommending that, and we're still waiting. There's a number of steps. The FDA then would have to then take that on. But right now, we know for Moderna is that this advisory board took a similar step that they took with Pfizer and BioNTech. So those that are 65 years or older, those that are potentially immunocompromised or work in an area of high risk that are between 18 and 65 can also sign up for a booster shot of Moderna. That was what the advisory board had scheduled. We're still waiting to hear from the FDA. And the big one, of course, especially for parents that are concerned about children and going back to school as we really head into the fall now, is going to be what they do in terms of those ages 5 to 11 on taking up those initial shots.
All right, Bloomberg's Anne-Marie Hordern with an important clarification in Washington. Thank you so much. And now let's get back to the stocks moving in pre-market trading here in the U.S. And I have to begin with Virgin Galactic. Of course, Richard Branson's space exploration company absolutely plunging to the downside in pre-market trading, down more than 20%. And that is after the company delayed the start of his actual commercial flights to space even further out into next year. The fourth quarter of 2022 is what they're now looking at. So that's pretty disappointing to investors. Another stock moving to the downside is Duck Creek, the software company. It released earnings after the bell yesterday, and its 2022 revenue forecast came up well short of expectations. So as a result, that stock is down more than 14%. One mover to the upside, though, is Alcoa, of course, the aluminum maker. It beat by and large after the bell yesterday and also is going to pay out a dividend for the first time since 2016 next month, really benefiting from those higher aluminum prices. So that stock is up about 5% before the bell, Francine.
Yeah, a lot going on in some of these individual commodity or steel producers. Coming up, bankers sound the alarm on inflation. The chief executives of Bank of America and Morgan Stanley join other finance leaders in predicting that price pressures will stick around. So we'll talk about inflation and what a policy mistake would look like. Then oil gearing up for a bullish week ahead as the global energy crunch tightens the crude market. We'll get a check on commodities. And European car sales the weakest since 1995 in September as the chip crunch takes its toll. More on that story ahead. This is Bloomberg.
I'm not a buyer of this story that it's all transitory, the inflation story. The supply chain interruptions, natural gas and other things have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now.
Right now, that inflation is clearly not temporary, and as people worry about, it's more permanent, and a way to conflate that is start to get to work on it.
Inflation in general, obviously, is running at a much higher pace than I think we thought it would be, just a few months ago, and certainly going to be there for a little bit longer. We are seeing a little bit of pressure in wages, but not across the board. Really only in certain pockets of the company.
Well, top banking executives weighing there on the inflation risk. Joining us now to talk about the markets, inflation, and everything in between is Christine Aquino, who helps lead Bloomberg's market coverage. So, Christine, as always, thank you so much for for coming on. Look, inflation. So you have the bankers saying inflation is not transitory, and yet you still have the central bankers saying, no, it is. And then we had that funny remark that Matt brought saying, well, maybe inflation is persistently transitory.
Yeah, I know. It's all about the narratives for inflation, isn't it, Francine? But no, I think you're absolutely right. There's this tension between what bankers are saying, what markets are expecting, right? And what everyday people are seeing in the prices of their grocery baskets, in wages, and what central banks are telling us. I mean, just before I came on here, I was reading a story about a London taxi company offering £5,000 as a welcome bonus for any drivers who are willing to join, right? So these are anecdotal evidence of inflation, whether you're a regular person or a bank CEO. But the question really is, when is that narrative going to convince central bankers, and when are they going to change their tune on whether it's transitory or maybe a little less so? Yeah.
I went to a bar yesterday that had a sign out front, an extra $500 immediately if you sign up as a busboy. So, or 500 euros, I should say. Christine, in terms, and by the way, I have to give Mohamed El-Erian credit for the inflation comment, because that was his comment yesterday on John Farrow's program,
funny.
and I believe he got it from an investment banker or someone at the Fed. In terms of the labor problem, is there any sort of sun on the horizon there? I mean, we had the expiration of jobless benefits. Kids have gone back to school, so people no longer have to worry about the little ones running around in the house. What do they need to have that improve?
Well, you know, Matt, I think there is a little bit of different factors here, right? Wages are definitely a part of the equation. I mean, when you're looking at statistics like job vacancies and indicative salaries in those job openings, you can see that there is kind of an upward trend both in the number of jobs available out there and the pressure on wages. But I think there's still a little bit of a mismatch, I think, in between, you know, the kinds of jobs that people are looking for, or anyone who's in the job market right now looking for it, and the openings that we have. I think some of the anecdotal evidence that we've seen of late, you know, shows that a lot of these openings are very much kind of in the lower paid sectors of industries, particularly in the hospitality industry. And so, you know, it's really kind of a question of how much will these workers want to be getting paid to go back into these very intensive but not very well paid industries.
Christine, I want to bring it back to investment in portfolio construction, because I feel like there's been a renewed debate this week about whether or not the 60-40 portfolio is in fact dead. Where do you fall in that battle?
Look, I think there's always going to be demand for bonds. You know, there are just big swaths of the investment community that will have to own bonds because of their mandates. You know, we're talking about the big institutional funds, the life insurer funds, all of these groups of investors are constantly looking for good entry points into the bond market. And, you know, earlier this week, I think we saw some evidence of that already, right? Where we saw a little bit of a bull flattening in the U.S. yield curve and other yield curves in major economies. We're also seeing some anecdotal evidence from Japan, for instance, big buyer treasuries there. And they were saying that a level of 1.75% for the 10-year treasury would probably be enough to entice them back into this market.
Christine, thank you so much. Bloomberg's Christine Aquino there with a take on the markets. Now, for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg. Well, this is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg First Word News. And in China, there are more signs of concern about contagion from the debt crisis at property developer Evergrande. Well, Beijing is now loosening restrictions on home loans at some of its largest banks. They've been told to speed up approval of mortgages in the last quarter. In California, well, former President Bill Clinton has been hospitalized after a urological infection developed into sepsis. Doctors say he's responding well to treatment and will remain at the hospital for observation. Bill Clinton is 75. And it was the worst September for auto sales in Europe since 1995. New car registrations plunged to 25% to less than 973,000. Well, that's put the industry on track to the worse than last year's disastrous showing. while the automaker's lobbying group largely attributes the drop to the semiconductor shortage. And the pandemic unleashed a deal-making and trading windfall on Wall Street firms. Banking lenders point to signs that it's far from over, while earnings reports by 5 of the nation's largest lenders include revenue hauls from investment bank at Morgan Stanley and Bank of America. JP Morgan sees higher compensation costs to reward performance. Citigroup says it's been hiring deal makers. Now, coming up, more on U.S. banks with Walter Todd, Chief Investment Officer at Greenwood Capital. We'll look at the winners and losers, and of course, we'll talk inflation, what that means for the yield curve, and what that means for investment in banks. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. And Matt, if you look at the markets, look, they're pretty happy about the U.S. earnings result, which means that they are not worrying at the moment about the future of energy and the energy crisis, and they're not too worried about inflation.
Yeah, I mean, you do see, obviously, energy prices climbing to a pretty high level. We saw Brent crude here this morning eclipse $85 a barrel. That's the global benchmark. And we heard from the IEA yesterday that the problems with natural gas are bleeding into other energy forms, other fossil fuel prices, and that's driving up prices across the market. So I think it's really interesting that the equity indexes are continuing to rise in the face of that, because you would think that that kind of inflation would worry stock investors. I think a lot of them are going to tell you, though, there is no alternative still.
No alternative. Kailey, this is all playing out on the markets, but it does seem like we had a pretty nuanced week.
Yeah, we did. Of course, you had that higher than expected CPI, then lower than expected PPI. That kind of complicates the inflation conversation. And we are in a very busy week of bank earnings. And bank and earnings so far have been pretty good. 5 of them have reported. 1 is left, Goldman Sachs, in just a few hours' time. So we'll have to see how that one goes. But for the moment, big banks have been aiding risk sentiment. In Europe, stocks are higher by about 0.3%. Your biggest sector outperformer on the Stock 600 is, in fact, the banks. Here in the U.S., we're coming off of the best day for the S&P 500 since March. And futures are in positive territory once again this morning, up about 0.25% on S&P E-minis. While you're seeing buying in stocks, you are seeing selling in the bond market. The U.S. 10-year Treasury yield is up nearly 4 basis points. We're just under 155 on that yield at the moment. And then I have to point to Bitcoin as well because of the Bloomberg scoop overnight that the SEC is looking like it will clear the way to a Bitcoin futures ETF, something the crypto world has been waiting for a very long time. So that has Bitcoin up about 2.8%, trading above $59,000. No surprise then, if Bitcoin is moving higher, a lot of crypto-related equities are moving higher in pre-market trading as well. BitDigital is up about 6%. You have Riot Blockchain and Marathon Digital higher by around 4.7% each. And of course, Coinbase is the crypto exchange, and it is moving higher by about 2% before the bell, Matt.
Yeah, you know, I thought the crypto news was really interesting, and not the only piece, the SEC, right? There's a lot more out there, but the price action in itself is what surprises me. $59,000 for a line of code. There's a lot of cash in this market looking for places to go. If you take a look at this chart, and for those of you listening on London DAB radio, I'll walk you through what you're seeing. M&A value, so deal value over the last, I guess this is a 10-year period, has just continued to climb and climb. Obviously, at the beginning of the pandemic, it dropped. But we're now hovering around record highs. Joining us to talk about what this means for the banks that he owns is Walter Todd. He's the Chief Investment Officer at Greenwood Capital. Walter, you own, if I'm not mistaken, shares in Bank of America, JP Morgan, Morgan Stanley. All of these banks are seeing fantastic advisory revenues. Is this a peak?
Yeah, well, good morning. Glad to be here. Yeah, that's definitely a question that the CEOs got on the calls the past couple of days. Is, can it get any better than this? And you know, it's a very consistent message that clearly investment banking and advisory fees, as well as equity trading, were big components of the beats that we got from those banks. But all 3 CEOs were pretty consistent that they think the activity is going to remain elevated. You talked about the liquidity in the market right now. I think honestly, the bigger takeaway, the more important one for me, aside from the M&A activity is the loan growth. We haven't seen loan growth from these companies in several years, honestly. And so we've, again, got a very consistent message from the CEOs that they're starting to see loan growth. They're starting to see credit card balances increase, spending's increasing. So very positive message across the board from those banks over the past couple of days. So that's encouraging for the outlook.
What about the old school business of banks taking in deposits and making loans? How is that doing in the face of, loan demand that isn't really that strong still?
Yeah. So if you look at that piece of the business, a couple of things. One, net interest margins look like they bottomed earlier this year. Again, you heard this from Brian Moynihan and Jamie Dimon on their calls that they're going to see a pickup in NII in the fourth quarter. So that's encouraging. And you are starting to see loan demand slowly increase, both from the consumer and the commercial side. So that's encouraging. And then the yield curve is steepened. It's not incredibly steep, but 120 basis points between 2s and 10s, that's going to help the margins at the bank. So some of that traditional banking business that's kind of been left for dead over the past couple of years is starting to reemerge. And I think that you're seeing the responses in the stock prices over the past few days.
Walter, good morning from London. How should we view the energy crisis? Is there a danger that actually the energy crisis, coupled with monetary policy, readjustment, means that a lot of companies will go under, will be left with zombie companies, and that hurts the banks?
Yeah, so Brian Moynihan on his call, or an interview, said pretty emphatically he did not think inflation was transitory; that it was more permanent. And energy is one aspect of that. We're not as concerned here in the U.S. As spend on energy and gasoline specifically is a much smaller component than it was, certainly 10 or 20 years ago. But in some of the emerging markets, it's more of a concern. It's a bigger piece of the pie of the spend over there. So that's something we're watching very closely. And clearly over in Europe, as real spike in energy prices there. We hadn't even gotten to winter yet. So that is a risk out there and a concern that we're watching very closely. But at this point, it's not, the market's kind of looking through that and think we can get to the other side of it.
When you look at some of the things that we look at, Walter, which is, possible consolidation, I don't know whether you'll see some of the bigger players move on to more well-known fintech in the U.S. and whether that will change some of their valuations once fintech is fully valued by shareholders.
Yeah, it's interesting. Jamie Dimon spoke quite a bit about this on his call about the competition from non-banks. The new buzzword is buy now, pay later, BNPL. We used to call that layaway when I was a kid. But anyway, it's you pay 30 times sales for that, and so you're definitely seeing that competition. I think there's a little frustration, from some of the leadership in the banks that the regulation on some of these non-banks is not as tough as it is on the traditional banks. But so they're using their capital. They have a lot of excess capital to get into this space. JP Morgan's made several acquisitions on that front. I think we'll continue to see that, but I don't see any of the large players that have gotten really too large, like Square and so forth, being acquired.
Walter, I was just taking a look at the thoughts you sent us before the show, and you make the good point that banks aren't really vulnerable to a lot of the supply chain issues and input costs moving higher that other companies are dealing with. If you put the banks aside, what sectors are you most worried about on the margin front in this earnings season?
Yeah, so for us, it's really, I think, the kind of the middlemen, if you will, in the industrial space and some of the materials, specifically the chemicals. So we've seen a fair number of pre-announcements from both of those areas in the last, call it month or so. And you saw the performance really suffer in the third quarter. Those were the two worst performing sectors in the market. So I think a lot of that's known now, but the question is, how bad is the outlook? And so I think that's really going to dictate how those stocks in those areas perform going forward, is when we actually hear from the management teams and get beyond this quarter, which we know is going to take a hit from a margin standpoint, and what does the outlook look like? So those are probably the two areas I'd be most interested to hear from the management teams on.
And finally, Walter, there's been a lot of chatter this week about the 60-40 portfolio and whether or not it can still work. Do you think it can?
Yeah, so yes. The short answer is yes. We have a lot of clients that play in that space in 60, 40, 70, 30, whatever you want to call it, because we do think at the end of the day, if we have a significant correction in equity prices for whatever reason, 10, maybe even 20%, we're not calling for that, but it could happen. Bonds are going to provide a ballast in that scenario. Clearly, fixed income returns are challenged, but we do think having a mix of stocks and bonds makes sense for a lot of clients.
Walter, thank you so much. Walter Todd there, Chief Investment Officer at Greenwood Capital. Now, coming up, the SEC is set to allow the first U.S. Bitcoin futures exchange traded fund to begin trading. So we've got that scoop next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, John Lipsky, former first deputy managing director at the IMF. That's at 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg. Breaking news just crossing the Bloomberg terminal. The PBOC saying Evergrande's risks to the financial system are controllable. China also asking banks to keep stable, orderly loans to real estate. The PBOC also urging developers and shareholders to fulfill their debt obligations. And Matt, of course, this is we continue to deal with the ongoing Evergrande crisis and those missed dollar bond payments. And it's not just Evergrande anymore. It has a contagion effect. You had Fantasia defaulting on a payment as well. It's also spread to the likes of Cynic in China. So clearly China is trying to get a handle on this, and the PBOC attempting to reassure investors that these risks are indeed controllable and that Evergrande isn't going to lead to any kind of disaster in the Chinese financial system.
Good to hear that reassurance. We'll continue to keep on top. I mean, obviously they're going to say it's not going to lead to disaster. It would be more interesting if a regulator came out and said this is going to lead to an absolute disaster that we can't control.
Fair enough.
But terribly unlikely that would actually happen. The SEC is set to allow the first U.S. Bitcoin futures exchange traded fund to begin trading. This would be a watershed moment for the cryptocurrency industry that we've been waiting for since the Winklevi. Let's bring in Bloomberg's MLive correspondent Eddie Vanderwall to talk to us about this. So it's been, I think, 8 or 9 years we've been waiting to get an ETF in the U.S. There already are a number of them in Canada that American investors, for the most part, have access to. But how important is this, Eddie?
Oh, I think it is very important, and we can see that in the price action. And you know what? There's been anticipation of this all year. The SEC has been indicating that, look, maybe they don't like outright Bitcoin-backed ETF, but they will be, welcoming towards a futures-backed one, which in the near term is extremely bullish. And, because there's a wider investment pool that will now have access to Bitcoin. We are bringing Bitcoin into the regulated space, and therefore more people will gain access to it. So I think, in the very near term, it's very bullish. But I think the long-term picture for Bitcoin is slightly different on this ETF.
Why, Eddie? Why is that timeline actually different?
So look, I think what happens here is, Bitcoin, the amount of Bitcoin outstanding is fixed, right? And no matter what you do, the algorithm creates as much Bitcoin as it will, and no matter what the demand is in the market. That's not true of futures contract, right? Futures contracts are potentially infinite. So therefore, if you're going to back it by a cash settled futures, then it changes the demand supply dynamics for Bitcoin significantly. And we've seen this in gold and other commodities as well. It displaces demand from people that would go out and register with an exchange that they will buy Bitcoin outright. And now suddenly they're going to buy something that's backed by a futures contract. And that's created volatility. If we look back at the commodities markets, if we look back at the oil market, right?
Yeah.
There's no reason why oil should have traded negative last year, or other than the fact that it was backed by there was this futures backed ETF contract that went haywire. So that's a really interesting development.
Well, Eddie, let's talk more about volatility, because I think we've heard often that when you get more institutional buy-in, when crypto becomes more mainstream, a lot of that volatility will go away. And we haven't yet seen that happen. Does an ETF make a difference?
I think an ETF does make a difference. I think Bitcoin's volatility is subsiding over time, right? I think we saw a massive drawdown in 2017. The price crash in 2017 was something like 80%. Last year, when we had a mania, or earlier this year when we had a mania, when the prices collapsed, it was more like 40% or 50%. So I think, you know, Bitcoin remains extremely volatile and is still only acceptable for, you know, the type of investor who is willing to take on that volatility. But it is becoming less volatile than it has been. And I think that's an important development.
It certainly is. Eddie, thanks so much. Bloomberg's MLive, Eddie van der Walt. Now, coming up, we'll bring you Bloomberg's interview with the Bank of America Chief Executive, Brian Moynihan, after the firm posted better than expected earnings yesterday. That's coming up, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Business is booming at Bank of America. The firm beat estimates in yesterday's earnings report, and its CEO, Brian Moynihan, spoke exclusively with Bloomberg's David Weston. Take a listen.
We're back. In other words, the activity levels and what goes on day to day is bigger than it was before the pandemic. We could talk about the economy and how that affects us, but the actual company got about half the people at work every day, and we're building that up as we go. And we've got, you know, we're doing our job for our customers and our clients, our communities, and our shareholders, as you saw today, while we're doing that. But we're still partway to getting people back at work and normalizing. That's had a town hall today with hundreds of teammates in the audience, and it's feeling more normal, but we still got to keep pushing ahead.
But your business is fully back to the levels from pre-pandemic?
In terms of, production of credit cards this quarter, for example, we did 1 million new credit card customers with our discipline, and that's as much as we did in 19. And so if you think about the company, we were on an organic growth drive in 16, 17, 18, and then we hit the pandemic in 19, and then we hit the pandemic in early 20. What you've seen now is, you just imagine, just like the economy, that was on an upward trajectory. It dipped, and now it's right back on that trajectory. And so are our loans a little less than they were then? Sure, but year over year, the loans are basically flat. They've grown 2 quarters in a row and are building. And on the deposits, it's been 15% growth year over year, 12% growth, those types of numbers. So that's not the question. And then on investment banking fees and those things are at record levels, and core loans are starting to build, and that's all going to bode well for us.
Well, that was Bank of America Chief Executive Brian Moynihan speaking exclusively to Bloomberg's David Weston. Now we're joined by Tom Keene, co-anchor of Bloomberg Surveillance. He joins us. He's, of course, in Washington from the World Bank IMF meetings. And I don't know, Tom, first of all, congratulations on a number of really news-setting interviews, but I don't know how much the focus is really on energy prices there.
Well, it's not on energy prices, but the backdrop here is inflation. And, of course, part of that is commodities. It's a very different set of meetings. Francine, I'll be blunt. You're not missing much. It is a post-pandemic, within the pandemic meeting. Francine, I'm thrilled to do this with you. This is my chart of the year. I'm announcing it today. It is a Bloomberg Commodity Index, and it's taken logarithmic, which means it shows percentage change. And I didn't know this, Francine. I stumbled into this by accident off of a nice long-term moving average. The percentage change that we have used that we have seen, rather, in the last number of months is very rare. We've only seen it 4, 5, 6 times going back to the 1950s. The abruptness of this move is extraordinary.
It is. And what's behind it, Tom? Is this all about the, yesterday the IEA was saying the natural gas crisis that we're facing here is bleeding over into other fossil fuel markets?
I think that's true. I think Fadi Birol's done phenomenal work the last number of days. He has the best essay on Glasgow that I've seen so far. What I would point out, Matt, is that when you're looking at a blended commodity index, you're looking at the softs, the hards, oil, yes, oil, and there's a number of different stories here. The major story is we've had a commodity-free lunch for, say, 20 years.
I don't know if you call it a commodity or a currency, Tom, but as a Bitcoin futures ETF, your entry point?
Oh, God. Why? Matt, she's supposed to ask that question to you.
Matt's already found his entry point, Tom.
Yesterday, she didn't care about Bitcoin. Today, Kailey wants to cover it. So,
there wasn't news yesterday.
$59,000 makes a difference.
You wise ass, here's what you need, Kailey. You need to read Raphael Auer of the Bank of International Settlements. I ran into Benoit Carré yesterday doing wonderful crypto work at BIS, and he and I were talking about the truly foundational work of Dr. Auer at the Bank of International Settlements, and he's a little bit worried about some of the Bitcoin foundations.
Yeah, I bet he is. And then central banks maybe not talking the same language as some of the Reddit users. Tom, thank you as always.
You guys are just dumping on me because it's Friday. This is terrible.
I know. It's Friday. You're in Washington, close to the White House. The sun is shining. We're all jealous, Tom. That's all it is.
The sun is shining. Weather's lovely.
There you go. Tom Keene there with the very latest from D.C. Now, this is a look at what else we're watching. And Kailey, you're looking at U.S. data.
Retail sales data at 8:30 a.m. Eastern time. We are expecting a small decline month on month. Economists thinking they'll be down about 0.2% in the month of September. But a lot of that, once again, is probably due to autos, because when you back out autos, we're actually expecting a gain of about 0.5%. Obviously, Matt, a very important read on the consumer. Not that any read on the consumer is not important, but really how much are they going out into the economy and spending, as we have seen sentiment waning a little bit?
Yeah, I think it's also interesting to see what happens when you back out autos. We have horrible numbers a couple days ago in China. Today in Europe, a drop of 25% in sales, but it's all about the supply chain. It's not that people don't want the cars. They're going out and they're having to pay top dollar. That's why when you remove the autos component, you see a flatter picture there. I'm watching Goldman Sachs earnings coming out a little bit later today, capping off what I think has been a really fast week. I mean, we've been so busy with all of these bank earnings that I just feel like it's flown by. Goldman Sachs is going to cap it off. The bar was high, but I think has been lowered. We saw financials go from losses to gains yesterday, so it'll be interesting to see how investors react to Goldman Sachs today.
Yeah, but it also reminded us, Matt, that there's so much in the pipeline in terms of either IPOs or actually consolidation. Even if we have zombie companies, once monetary policy normalizes, that is always encouraging news for the banks because they get deals out of it and they have to step in and see exactly how to break it up. I don't know, anyone's guess. I spoke to a restructuring expert, actually, who said this could be, in the next 12 to 18 months, and watch out for specific countries like the UK. Now, we also heard from Evergrande. This is significant, not because they said that everything is under control, but it's significant because it's taken them a while to actually break their silence. Now, they say that risks to the financial system stemming from the struggle are controllable and unlikely to spread. And of course, this goes to the fact, Matt and Kailey, that there is political will. If they come out and saying, look, the risks are controllable, to deal with it. And because China's China, you kind of take them at face value. If they say, look, we're controlling them, then actually they definitely have the levers to do so. So we'll have plenty more on that. Bloomberg Surveillance. Coming up ahead, we'll hear from Kit Jukes, Société Générale Chief FX Strategist, and Margie Patel of Wells Fargo, amongst others. Also, from Monday, you'll be with Anna Edwards. I'll be doing the European Market Open. So, guys, I'll miss you, but I'm not far away. So we'll be able to talk markets, foreign policy, Europe, and Brexit at any given moment.
We'll miss you, Francine.